The structural leverage is higher, so the same size order produces a bigger effect. Now, watch this final contradiction. The market can return to calm and the crowd will still believe it's stable because it will look like a normal consolidation until it doesn't. Until one day, a headline lands that isn't about earnings. It's about a technical glitch or a liquidity event. And at that moment, everyone who laughed at Gamma will try to model their exposure at the same time. That's when the exits shrink. So here's our move. We stay calm, we stay in the data, we watch the structural indicators, we separate facts from stories, and we don't let the price action hypnotize us. If you want us tracking the gamma, the depth, and the fallout from today in real time, the door is here. Short, simple, and you'll see the wires behind the screen. And keep your eyes on the opening prints tomorrow because the first real clue won't be a gap up. It'll be a failure to fill, a stubborn refusal of the price to return to where the fundamentals say it should be, the kind that tells you the liquidity isn't low, it's gone. Now let's get even more concrete because volatility is a lazy word. Volatility can mean two different things. One is implied volatility, the price of options, the fear in the room. That's a sentiment gauge. The other is realized volatility, the actual jagged movement of the asset itself. That's a measurement of structural integrity. Today, the danger was the second one. A gamma event isn't the same as a news event. News moves price through human reassessment. Gamma moves price through mechanistic, uncompromising rehedging. A portfolio manager can wait out a news cycle. An algorithm can't wait out a margin call. So when we talk about a gamma squeeze in a low liquidity environment, we're talking about the stage of the market where human discretion has been removed and pure automated physics takes over. That's why it hits like a hammer. And here's the part that feels counterintuitive. Even if the overall market capitalization is stable, the tradable liquidity can still vanish. Market makers and dealers are the valves. If the valve gets stressed, the total assets don't save you. That's what makes this a market structure story, not a simple bull or bear story. Now, think about who trades gamma and how they behave. A retail buyer buys a call when they feel greedy. A dealer sells that call when their model allows it. They don't get to feel, they get to manage risk. So when dealer gamma positioning is large and one-sided, it becomes the floor or ceiling. It becomes the non-negotiable force in the market. And we are at that point. The zero-day option market is the obvious one. Every contract is a tiny gamma bomb, and the world is trading them like it's a video game. It's 1,000 little tripwires on the same wire. The hedging flow is quieter, but constant. Futures, ETFs, variance swaps. Gamma is the silent gravity in the digital trading universe. The rise of passive and systematic strategies adds another layer, not because each one is a gamma monster on its own, but because the sheer size multiplies the herd behavior, all moving in the same way at the same time, where dealer hedging earns its keep. In a crisis, AI doesn't run on judgment. It runs on models. Models run on inputs, and inputs love clean, liquid data. Now, can dealers reduce their gamma exposure? Yes, sometimes, but the tools are limited and the demand for options is structural. So the question becomes, can liquidity do anything structural in response? This is where the byproduct trap returns. If most liquidity is tied to dealer profitability and regulatory capital, liquidity is a passenger. You don't control the depth of the market by yelling at the passive ETFs. To increase real liquidity materially, you need either more risk-seeking market makers or a fundamental change in market structure or a volatility miracle. And the volatility miracle is a beautiful story that often collapses under a flashlight. Volatility is widely dispersed. It's in the mood of millions of participants. Calming it can be impossible unless the structure itself changes. Even then, stability has a time delay. The structural damage done today doesn't heal tomorrow. It comes back years later after a crisis forces a rule change. So the structural reform people are counting on is not a next week solution. It's a 2030s conversation, which means next week lives on the same fragile plumbing. The pipes are already stressed. So when we hear single block trade, we should translate that into plain language. It means the market just moved from a deep lake of diverse opinions into a controlled canal of forced hedging. Sometimes the canal flows smoothly, sometimes it doesn't. But the price no longer controls the timing. That uncertainty alone forces behavior changes. Algos get more conservative, bid-ask spreads widen permanently, dealers pull back from providing size, and caution accelerates fragility. It's the same dynamic as a bank run. The bank can be solvent on paper until too many people demand cash at once. Then the only thing that matters is what's in the vault today. Now let's talk about how this shows up in price without pretending we can forecast the exact number. In a normal trend, price rises because capital flows in. That's organic, but it's slow. In a gamma squeeze, price rises because the marginal buyer is not optional. The buyer must buy now. That's why these moves gap. They don't climb stairs, they take elevators. And the scariest part is how quickly the psychology flips. One day, everyone says, the market is liquid. The next day, a trader says, I can't sell my size without moving it 5 handles. And suddenly, liquid turns into illiquid. Now, we should also be honest about the counterpunch. The exchanges and the dealers themselves can intervene. They can widen margin requirements on those specific options. They can halt trading. They can call the client and negotiate a risk transfer. That can create violent reversals that feel like the story is over. But in a true structural fault, reversals are often just pauses while the underlying fragility remains. So we need discipline. We don't confuse a one-day reversal with a structural repair. Now, here's a simple mental model we can use. The spot price is the weather. Market depth and dealer positioning are the climate. Weather swings, climate shifts. If the climate is becoming more fragile, a sunny day doesn't end the drought. So what's the climate signal? Persistent negative gamma in key expiries, persistent wide bid-ask spreads in the futures, persistent low volume in the resting order book, and most of all, persistent participation from players who treat options as lottery tickets, not insurance. Now, let's address the big fear people have, but rarely say out loud. What if this turns into a deleveraging cascade? Because if gamma exposure becomes unmanageable, dealers don't just watch, they act. They hedge violently, they refuse to quote size, they increase margins, they redirect risk into other venues. That's not a theory. It's how modern financial plumbing works. And the leverage in the system is being treated like a controllable variable in many models. If a dealer decides that its survival is critical, it will not care about a fund manager's desire for tight spreads. Survival beats customer service every time. So the risk isn't only higher volatility, the risk is execution. An execution risk is the kind of risk the average chart watcher never prices in. Now here's the most important open loop in this entire story. If the market can't rely on deep, continuous liquidity the way it used to, where does the replacement stability come from? And how fast? We can create new ETFs slowly. We can change regulations even slower. Studies, committees, political will, industry pushback, years, and the clock doesn't care that we're trading in milliseconds. So, when analysts tell you the market will adapt, we should respond with another one-liner. How many nanoseconds does it take to rebuild trust in an order book? Now, you might be thinking, okay, but if the price goes wild enough, won't someone step in and provide liquidity? Yes, price can unlock liquidity from value hunters and contrarians, but unlock is not the same as refill. The system can clear at a new, volatile equilibrium, but the clearing price might be far away from where most models expect it. That's why these moves are so violent. The market for immediate execution is small relative to the size of the derivatives hanging over it. It's like a narrow bridge on a digital highway. Data flows look fine until one packet gets delayed, then the entire network jams. And that brings us to the key signal we should watch after today's closing bell. Does the options skew collapse tomorrow? If the frantic call buying evaporates, it suggests the event was a one-off, at least for now. If the skew holds or worsens, it means the speculative pressure is still building, paying to gamble on more dislocation today, not tomorrow. And if we see skew hold while market depth stays anemic, the next step is ugly. It's breakdown by physics or breakdown by regulation. Either way, the market stops behaving like a market. So here's what I want you to do right now. Don't get hypnotized by the after-hours tick. Watch the pre-market futures depth. Watch the first options prints tomorrow. Watch the gamma levels at the open. And tell us, do you think the next crisis is about price or about mechanism? Because the moment the market shifts from how high will it go to can I get out, the game is no longer a trade. It's a test, and the test doesn't announce itself in advance. It announces itself with a failed order, a widening spread, a risk manager saying, we're pulling our quotes. That's the line that changes everything. And when you hear that line, the chart you're watching won't matter. The only thing that will matter is who already has their size executed. So keep your eyes on the morning, because the first hour after a structural tremor is where the truth leaks out. Not through speeches, through spreads. And if the truth is ugly, we'll see it first in the options paper, then in the futures book, then in the headlines. By the time the headlines arrive, the easy exit is gone.